Hello and welcome to today's presentation. We're going to be taking a look at disability insurance. A lot of people actually don't have disability insurance. They may think they do have through the workplace, or if they do have it through the workplace, they think it's enough to actually cover in case something happens. I encourage everyone who has disability insurance through the workplace to take a look at their booklet to see how much is actually covered to what certain amount. I found in the past that some clients actually had a short-term disability that covered up until, let's say, $2,000 a month, when in fact they actually earn $4,000 a month. And then long-term disability kicks in and only covers them basically on their base salary. So a lot of salespeople, they're operating on base plus commissions. So the problem with disability is that it only covers you on your base salary. It doesn't cover you on your commissions. So that's why it's important to understand what kind of coverage you have, and to top up. So if you do need additional coverage because you're finding that your workplace doesn't give you enough, there are alternatives out there. Or if you don't have coverage, definitely look into getting it. And we'll go over this process, because a lot of people think insurance is really expensive. It's not. It's actually more expensive not to have it. I know a lot of people may roll their eyes at that comment right there, but it is true. It does become more expensive if you don't have it. Pause the screen, look at my mission statement here. I'm not going to read it through just because it'll save some time. So what we're going to take a look at here, I'll just zoom this up a bit, is three types of coverage. So we're going to have disability coverage that has a 0-day waiting period. So effectively, if you become disabled or injured on workplace, off workplace, then essentially you'll start from day one, 30-day wait. So you have to wait 30 days to begin the claim. So once you put the claim in, it's 30 days from the accident, or 120 days. So the difference between these two, as you can see, is the lesser that you wait, the more expensive the premium is, and all the way down to 120-day wait. So what you have to realize here is that if you're going to go with the cheaper option, which a lot of people do, try to make sure you have 3 months of emergency savings in your bank account or in your tax-free savings account, wherever, because if you are disabled and unable to work, can you pay your day-to-day expenses while you wait for the disability to kick in? Okay, so what we're looking here, this benefit is for $5,000 per month up until age 70. There's also partial disability, so if you're unable to work the full 5 days that you're scheduled to work, then essentially you can qualify for half the disability amount at $2,500 per month. Okay, so little tidbits here. Currently, right now, there's 3.8 million Canadians living with disabilities. Everyone has a 1 in 3 chance to experience a disability that will last 90 days or more. The average length of long-term disability is almost 3 years. It's 2.7, 2.8 years. And nearly 50% of bankruptcies and mortgage foreclosures are actually caused by disability. So, again, consider the risk of disability in your future. If you're unable to work due to an illness or an accident, could you continue to pay your bills and maintain your lifestyle without an income? So in this example here, we're taking a 50-year-old client, non-smoker, and essentially looking at the maximum benefit that he can attain, which is about $5,000 a month based on his income levels. Okay. So, as you would have guessed, the 0-day waiting period, over time, you pay more for it because you just want it to start from day one. You don't really want to wait, or you have other direction for your emergency savings, so you don't want to waste any time, or you don't know where you're going to be financially when the injury occurs. So where this, you can start to see the difference here is that I like pictures, so sorry I'm scanning through this quite a lot. Actually, right here's perfect. take a couple of the fields off here. The cash values are the same, but I just want to show you here is essentially that if this 50-year-old male were to become disabled year one, and it's going to be prolonged and it may last until age 70, he will effectively receive $1.26 million over the 20 years. If you become disabled, let's say in year 5, then, okay, year 6, why is that? Is it clicked over? Okay, year 5, there we go. Then the 50-year-old male will actually just receive over 1.02 million. So again, you're paying $2,800 a year for coverage that you could potentially receive $1,020,000, or yeah, $1,020,000. Now, a lot of people may say it's like, I'm going to pay all these premiums. Let's say I get injured in year 19 or year 20. So when you're in year 20, you effectively will receive $120,000. Year 19, $180,000. So when you actually accumulate all of the premiums, even in the 0-day waiting, it's $56,100. When we look at the comparison here, if you were to have a 30-day waiting, $38,000. 120-day waiting, $28,380. So that's total premiums over 20 years. So if the 50-year-old individual were to become disabled in the 19th year and have 2 years of disability, well, they effectively will receive $180,000 for either $28,000 of cost, $38,000 of cost, or $56,000 of cost. That's a pretty good return on investment. Okay, so we're just going to scroll down here. Apologize, but there's a lot of detail in here that it's really not necessary to focus in. It's just more for the expert when they look at the final numbers. So here we look at the cost of per thousand of coverage. Obviously, the shorter period you wait, the more costly per thousand it's going to be versus the 120-day waiting period. So you can just see how the cost of insurance increases over time. But what I like to look at is essentially the rate of return. So I look at insurance as a return on investment. You're putting monies aside for the coverage of potential of using it. So obviously, let's focus in on maybe the 14-year. If you were to become disabled and you have either the coverages, you'll have effectively a 30% rate of return on your investment, 34, 38. Okay, so I can't do that. I do investments for clients. I can't guarantee these returns year over year. So that's effectively 30% over every year for 14 years. That's what that number basically means. So when we look down here, 25% every year for 15 years, I can't do that. So over a 20-year period, if you're to self-insure and it's effectively putting your $28,000 or $30,000 in there and then pull out $120,000 effectively, that's essentially just under a 7% rate of return over a 20-year period. That can be done in the investment world. However, when we look at where the economy may be, whether it's a recession or anything like that, guarantees, insurance is the only thing that really can make that possible. One thing that I like here is that what is the rate of return if we were to actually physically deposit our premiums into a tax vehicle and to receive the benefit at the end of the day. So when we scroll down here, just look at the final numbers. So in order to actually yield a 6.79% annual rate of return net, you actually have to try to gain in a tax investment vehicle, whether it's in a non-registered RSP or anything like that, 13.62% every year for 20 years. So this right here, if anyone promises you that number every single year, run. And this basically shows the comparison between the 0-day, 30-day, and 120. So again, like, these numbers are impossible to guarantee in the investment world. So to have a guaranteed rate of return of 12.37% for effectively getting a payoff for just 1 year, and you funded it for 20 years, that's still a great return on investment. So that's the end of the presentation. It was quick. Feel free to give me a call at 905-366-4431 or shoot me an email at david.corrado@dfsin.ca. These figures were for a 50-year-old male. It's not that expensive, as you can see. You know, depending on how much you earn, you just have to take a look at your budget and basically see how you could, you know, fit this within it, because at the end of the day, it's going to save you a ton of money. Even if you go on disability for a short period of time, this is really like less than, you know, a cup of coffee a day. So let me know, shoot me an email. All I need is your date of birth, whether you smoke or not smoke, and I can email you some figures and be able to let you know at least what the cost could be for yourself. Okay? Thanks again. Have a great day. Take care.